The most dangerous trap of the market is making you believe that the move is already obvious. And it's exactly at that moment that most people lose money. When the crowd sees perfect growth, smart money is already thinking about where to take liquidity. When the crowd panics and sells, big capital starts looking for buys. The market doesn't move on crowd emotions, but on liquidity. And imbalances are one of the few tools that let you see this directly on the chart. Stay until the end. I'll show you how large players leave footprints on the market and how to use that against the majority of traders. If you're not yet subscribed to my YouTube channel, now is the perfect moment to do it. And don't forget to like this video. For the growth of the channel, it really matters. We regularly release valuable content that helps you better understand the market and apply knowledge and practice right away. And if you want to see how all these concepts work in real trading, join my Telegram channel. The link is in the description and the QR code is right on the screen. Now let's get to the point. What imbalance really is. Imbalance is an empty zone between candles that appears during strong impulsive price movement. Simply put, it's a section of the chart the market passed through so quickly that no proper exchange occurred between buyers and sellers. Technically, it looks quite simple. Take 3 consecutive candles. In the bullish scenario, the high of the first candle's wick doesn't touch the low of the third candle's wick. Between them remains an empty area, which price literally rushed through. What happened at that moment? Big capital started buying so aggressively that available liquidity wasn't enough. As a result, demand sharply exceeded supply. Counter orders quickly ran out. Price instantly moved higher without forming balance. The market simply didn't have time to conduct a proper exchange between buyers and sellers. That's why this area looks empty. So, at that moment, trades were extremely few or absent altogether. Fair value didn't form. Balance between market sides wasn't found. What happens in the bearish scenario when the market falls? The logic remains exactly the same, only reversed. How it looks technically. Again, take 3 consecutive candles. In the bearish case, the low of the first candle's wick doesn't reach the high of the third candle's wick. Between them appears an empty zone above. What does this mean? On this section of the chart, a gap has formed. Price literally dropped through the level, barely stopping. Why does this happen? The reason is simple. Supply begins to significantly outweigh demand. Imagine a regular store where suddenly everyone decides to sell their goods at the same time. Sellers become too many, buyers aren't enough, and prices start to fall sharply. The market works the same way. Large participants begin selling aggressively. Buyer liquidity isn't sufficient. Price quickly moves down. Result: the market skips the stage of forming fair value in that part of the chart. What really happened at that moment? A powerful wave of selling hit the market. Liquidity on the opposite side, buyers, was too little to hold price at those levels. As a result, the market didn't manage to form fair value. No proper exchange occurred between buyers and sellers. Price simply dropped through that range. That's why an empty zone remains there. And just like with bullish imbalance, the market doesn't like such voids. Over time, it tends to return to this area to compensate for the imbalance. That's why bearish imbalance also works like a magnet for price. When you see such an empty area above current price, it's a potential zone the market may revisit later. This is exactly where many traders start looking for opportunities to open short positions. Where do these gaps come from? The main reason imbalances appear is the actions of large market participants. When funds, market makers, or banks enter positions with huge volumes, liquidity often isn't enough to instantly absorb the entire flow of orders. What happens next? A strong impulse forms. A mismatch between supply and demand arises. The market remembers this area and later tends to return to it. That's why imbalances so often act like magnets for price. Now is the perfect time to talk about my Telegram channel. If you're just starting to explore the crypto market, it's important not just to watch price, but to understand what truly drives chart movement. It's crucial to see what experienced traders and investors pay attention to, instead of making decisions under the influence of news, noise, and crowd emotions. On my channel, I regularly share my own view of the market and expectations for its future development. I explain the state of the global economy in simple words, break down the impact of key macroeconomic data, and openly show both my short-term trades and long-term investments. Join in and study crypto with a cool head and a systematic approach. My goal is to help you avoid the mistakes that cause most beginners to lose their money. The link to the channel is in the description under the video. Now let's return to terminology. FVG, fair value gap, one type of imbalance. Essentially, it's a price gap that appears when the market moves so fast it skips certain levels with almost no trading. Later, price often returns to this area to compensate for the imbalance. Simply put, it's the empty zone between candles, which the market often revisits after some time. Bullish FVG, a gap formed during upward movement. When price returns to this zone, traders see it as a potential buying area, expecting the uptrend to continue. Bearish FVG, a gap formed during downward movement. When price returns to this zone, traders look for selling opportunities, expecting the downtrend to continue. Sometimes, instead of FVG, you'll hear the term price inefficiency. In essence, it's the same phenomenon, only the wording changes. The opposite is efficient pricing, when price moves smoothly, consistently, and without noticeable gaps. How a trader uses imbalances. From a practical perspective, imbalance serves 2 main functions. It attracts price. The market tends to return to the area of price inefficiency and fill the imbalance left behind. It creates a reaction. After price revisits this zone, a strong impulse often follows in the direction of the main trend. For a trader, this is an area of interest, a place where the market may stop, reverse, or accelerate. That's why such zones often become potential entry points for trades. Working with timeframes. Higher plus lower combination. Any analysis begins with a higher time frame. Higher time frame shows intentions of big capital, key zones of interest, overall direction of movement. Lower time frame is used for detailing the entry area, finding confirmation signals, validating the chosen scenario. This is one of the fundamental rules of market analysis. First, the higher time frame, then the lower. Only after that do we look for the entry point. Premium and discount. How to choose the priority zone. To determine which imbalance has greater priority, traders use the Fibonacci grid. In an uptrend, it's drawn from local low to high. In a downtrend, from local high to low. The 50% level is considered the balance zone, or fair value. Everything above belongs to the premium zone, where the asset is relatively expensive and selling makes more sense. Everything below belongs to the discount zone, where the asset is relatively cheap and buying makes more sense. Buying at a premium or selling at a discount means working against market logic. What does this usually lead to? Lower success rate, less favorable risk-to-reward ratio. Liquidity, the fuel for market movement. To understand the logic of price action, you need to grasp one simple principle. Price always moves from one liquidity pool to another. Liquidity is the fuel behind every market move. External liquidity, stop losses and orders placed beyond local highs and lows. Internal liquidity, orders located inside the trading range. If you look at market behavior, you'll often see the same scenario repeat. The classic cycle looks like this. Market takes external liquidity, then makes a correction, returns to fill imbalances, and continues the main move. This process repeats again and again across all time frames. Now let's build a simple analysis algorithm. Just 3 steps. Step 1. Define the trend direction and structure on the higher time frame. Step 2. Mark the key liquidity zones price may target. Step 3. Find current imbalances that can become points of interest. Even these 3 steps are enough to build a working scenario with high probability of success. Entry on the lower time frame. After that, switch to the lower time frame. We have 3 main tasks. Refine the boundaries of the entry zone. Get confirmation of the scenario. Identify the exact entry point. What can be considered confirmation? Liquidity sweep, break of structure, BOS. Formation of a new imbalance. And here's an important nuance. Even if structure hasn't yet broken, the very fact of price returning to an imbalance zone can already be treated as an early signal worth attention. And if you want to dive even deeper into these concepts and learn how to spot them in the real market, you already know where to find the link to our Telegram channel. Mathematics and risk management. Now let's talk about what truly separates a trader from a gambler. Mathematics. Suppose you work with a risk-to-reward ratio of 1 to 3. In that case, for a positive result, you only need to win about 33% of your trades. Think about it. You don't need to predict the market constantly. You don't need 80 or 90% successful entries. Even if 7 out of 10 trades are losing, you can still remain profitable over the long run. This is the power of a systematic approach. It transforms trading from a chaotic attempt to guess the future into a disciplined strategy where statistics do the work. Professional trading is built on this. Proper risk management and maintaining a statistical edge. Let's sum it up. Imbalance is not a complicated theory or some magical indicator. It's simply a section of the market where buyers or sellers entered so aggressively that price didn't have time to form naturally. When you understand the overall market context, work correctly with higher and lower time frames, account for liquidity zones, the market stops looking like a random set of moves. It becomes much clearer, logical, and predictable. But theory alone is worthless. Progress comes only through practice. Run back tests on historical charts. Scroll the market backwards and analyze scenarios. Work them out on a simulator to reinforce skills. Every backtest, every chart replay, every scenario practice on a simulator is a brick in your foundation. The more quality practice you get now, the fewer costly mistakes you'll make in real trading. In essence, you're training your eye and your thinking just like an athlete trains movements in practice. In the real game, he acts automatically because the body remembers. Trading works the same way. The more repeating market patterns you've seen, the faster and more confidently you make decisions without unnecessary emotions. If this video was useful, make sure to like it, subscribe to the channel, and check the description. There you'll find all the links, extra materials, and tools for further learning. Thank you for watching. See you next time.